Chipotle Mexican Grill has become a favorite for those who want fresh, customizable bowls and burritos. The company has seen incredible growth, expanding to thousands of locations and building a loyal customer base. Recently, however, Chipotle has faced a tough year. Sales have slowed and the stock price has dropped by more than 30% since the start of the year. For some of you who have been following my channel, you know I like to find value stocks. Recently, I have been focusing on Chipotle stock. I have been looking at the numbers, and based on some fundamentals, I believe this slowdown may be temporary, and Chipotle could be preparing for a strong rebound. Let's take a closer look at what's going on with Chipotle, why the company is struggling, and why I believe we're going to see a rebound in the near future. In 2025, Chipotle's stock took a big hit. The reason for that was because same-store sales, which measure how much existing restaurants are selling compared to the previous year, went down. In the second quarter, sales at existing restaurants fell 4%, and the company predicted that sales would stay flat for the rest of the year. This was a surprise because for the last 3 years, Chipotle had been growing same-store sales by 7% to 8% annually. Investors started to worry that maybe the company's growth story was ending. One reason I'm hopeful about Chipotle is its strong value for customers. On average, Chipotle meals cost about 25% to 30% less than fast casual rivals like Cava and Sweetgreen. Even compared to fast food giants like McDonald's and Taco Bell, the price gap isn't that wide anymore. McDonald's meals are often less than 10% cheaper than Chipotle's. This is a big deal. Over the past few years, traditional fast food chains raise prices aggressively. Customers looking for value might now see Chipotle as the better deal, especially since its food is fresh, customizable, and made quickly. This balance, being cheaper than high-end fast casual, but not much more expensive than traditional fast food, gives Chipotle a strong price position. In today's economy, where people care about both cost and quality, that position could help keep restaurants busy. In an interview with Jim Cramer, CEO Scott Boatwright addressed the company's struggle by highlighting his commitment to enhancing the customer experience amid rising food costs and delivery fees, which have made eating out more expensive. Boatwright emphasizes that although the stock has underperformed compared to other restaurant chains and the broader market, he remains confident in long-term growth potential and strategic plan. Chipotle is not just relying on price. The company is also making big investments in technology and equipment to improve efficiency and cut costs. For example, Chipotle is retrofitting hundreds of restaurants with new grills, rice cookers, and chip fryers that work faster and use less energy. These changes could save each restaurant between $12,000 and $18,000 in worker hours every year. Chipotle is also testing new automation tools. One is called the Autocado, a machine that helps prepare avocados, one of Chipotle's most expensive and labor-intensive ingredients. Another is Hyphen, an automated system that assembles bowls. These technologies could reduce costs even further while improving speed and consistency. For customers, this means shorter wait times, fresher ingredients, and possibly lower prices. For investors, it means higher profits and stronger growth potential. Chipotle also has plenty of room to grow. Right now, most of its locations are in the United States, but the brand is starting to expand more aggressively overseas. It already has a presence in countries like Canada, the UK, and France, and international expansion could be a huge growth engine in the years ahead. Back at home, Chipotle is still adding new stores at a steady pace. With its strong brand, loyal customers, and proven business model, new locations often perform well right out of the gate. That kind of best-in-class unit economics, as analysts call it, makes Chipotle a reliable growth story. Another reason I'm optimistic about Chipotle is its financial health. Even after a rough year, the company trades at about 31 times projected earnings for the next 12 months. That may sound expensive, but it's actually the lowest multiple Chipotle has had in a full year since 2015. And unlike back in 2015, Chipotle today is a stronger company with better operations, more stores, and more growth opportunities. That makes the current valuation look attractive for long-term investors. Chipotle also has little to no interest-bearing debt. It rents most locations instead of taking big loans to buy real estate, so it isn't weighed down by monthly interest bills. In a world of higher rates, that's a real edge. From a technical perspective, the stock looks oversold after its 30% drop this year. The shares recently bounced off the $40 support level, showing buyers are buying in at that price. The stock remains well below its 200-day moving average. Trading at 31 times forward earnings, its lowest valuation since 2015, the technical setup suggests a potential bottoming pattern rather than continued weakness. The challenges are real, but the company is tackling these problems head on. With smart pricing, new technologies, and continued expansion, Chipotle has the tools it needs to bounce back. If you're willing to look past short-term struggles, this stock could offer big rewards in the years ahead. If you enjoyed my analysis of Chipotle stock, make sure to subscribe and check out my other stock-related videos. Until next time, goodbye.